This is a little bit more complicated. This is probably the most complicated type of return out there. It's actually so complicated that it actually has its own formula in Excel to actually calculate it because it's very difficult to calculate manually. All right, welcome back to the channel. Thank you for watching. My name is Brian Force, one of the founding partners here at Deep Blue Capital. And today we're talking about the different types of returns in multifamily real estate investing. But before we get started, please do the thing, hit the notification bell, subscribe, all that type of stuff, and then make sure you go on over to deepbluere.com. We've got all kinds of educational content over there, and create your investor profile so you can get access to our weekly newsletter, upcoming opportunities, and you can invest in one of our upcoming deals. All right, so you looked at multifamily investments, or you're just getting into the business, or you have been for a while, but you've never really done a deep dive on all the different types of returns a multifamily investment can offer. There are several. There's different definitions. They can be a little confusing, so we're going to dispel all of that today, break down the different types of returns, what they mean, what they are, and what to look for when potentially considering an investment opportunity. There are four main types of returns in a multifamily investment. There is the cash-on-cash return, there is the internal rate of return, there is the equity multiple, and there is the average annualized return. Those four different types of returns are usually the metrics that a syndicator is going to advertise when they're sending you a deal, and they're going to have projected returns. Those are basically the target returns that they're looking and expecting that deal to provide if everything goes to plan and they execute their business plan well. So let's talk about each one of those types of returns. The first type of return is called the cash-on-cash return. Cash-on-cash return is very simple. It is the average annual cash flow that I am making per dollar that I am investing. So what that means, let's say I put $100,000 into an investment. If I'm making $10,000 in passive income per year on that investment cash flow, then I have a 10% cash-on-cash return. It is basically the percentage of my initial investment that I am making in cash flow every single year. So 10,000 on 100,000 would be at 10%. 50,000 and I get 5,000 in cash flow, that would be a 10% as well. So the percentage of my initial investment that I'm getting back in cash flow every year, that is my cash on cash return. The next type of return is called the IRR, or internal rate of return. This is a little bit more complicated. This is probably the most complicated type of return out there. It's actually so complicated that it actually has its own formula in Excel to actually calculate it because it's very difficult to calculate manually. The internal rate of return, in simple terms, is essentially calculating your return on investment while also taking into account the time that your investment is going to be, the time that your cash is tied up in the investment. So basically what it does is it takes your investment and all the cash flows from that investment, it considers the net present value of those cash flows as zero. In very simple terms, what internal rate of return is, it basically takes into account how long your money is going to be tied up. And it's a great way to compare one investment to a different investment that might not be in the same type of asset. So internal rate of return is very important because if you have your money tied up for an extended period of time and you can get the same return by tying your money up for a shorter period of time, then the internal rate of return of that second investment is going to be better. So rather than just looking at average returns or equity multiples or cash on cash or total returns, the internal rate of return helps you account for what else you could have done with that money if it wasn't tied up in this investment. So internal rate of return can be complex and nuanced, but just understand that the higher the return, the more you're getting for your money pound for pound based on how long that money is going to be tied up. The next kind of return is called the equity multiple. You'll see this from syndicators and people offering investment opportunities all the time. The equity multiple is essentially a multiple of how much you can expect your initial investment to be multiplied by during the hold period. So let's just go back to that $100,000 investment example. If I have an equity multiple of 2.0x equity multiple, then I can expect to turn that $100,000 into $200,000 over the course of the investment. So an equity multiple, the best way to think about it is to take the equity that you're putting into the deal, the investment that you're making it, multiply it by the equity multiple, and that's how much you can expect to pull out of the deal when that investment is over. So a 2x equity multiple is basically the bare minimum for a deal here at Deep Blue Capital. We won't even really consider anything for the most part that doesn't provide at least a 2x multiple, but that is what equity multiple means. It means basically multiply your investment by that equity multiple, and that's what you can project to make on this deal if we execute our business plan well. And lastly, you have average annualized return. The average annualized return is a very important metric because not every single year are you going to make the same return on a multifamily investment. If you're going into a big value add opportunity, for example, you may have a smaller annualized return on the front end and a much larger annualized return on the back end. So if you have a 5-year hold, you may have a smaller return on the front end because we're doing a huge CapEx project, a big lift. We're refurbishing the entire property, and then we're going to get rents up. Then we're going to streamline operations. Then we're going to create more cash flow, and then the value of our asset is going to go up, and we're going to have a higher return on the back end. So what the average annualized return does is basically take all of the returns for the entire investment period into account and averages them out. So you can expect if I have a smaller return on the front end and a larger return on the back end, I'm going to have an average return somewhere in the middle. So it just breaks down the average returns for the entire hold period so you know what to expect. There you have it. Those are the 4 major types of returns: average cash on cash, IRR, equity multiple, average annualized return. You need to understand how these fit into your investment goals and whether or not those returns meet your return profile and risk profile. In order to do that, make sure you go over to deepbluere.com, create your investor profile, schedule a call with one of our partners, and we can help you understand how your wealth building goals align with these strategies. And now you at least have a little bit of an education on what to look for and how to underwrite a potential investment on your part so you know if this multifamily deal aligns with your wealth building strategy. Appreciate you guys watching. Make sure you hit the notification bell, subscribe button, all that type of stuff. I'm Brian Force with Deep Blue Capital. We look forward to talking to you soon.